This Wednesday, September 18th, the Fed is about to cut rates. Now, I think it is shaking in its boots because it doesn't know whether to do a 25 basis point rate cut or a 50 basis point rate cut. You know what? It's too noisy out here. There's kids on scooters. Let me take this inside.
So the extremely crucial Fed rate cut decision is going to be happening on Wednesday, September 18th. Ironically, the same day that we had a Fed rate cut after the hiking cycle of 2007. The first time that the Fed cut rates in 2007 was September 18th. No, that does not make 2007 like today. As a matter of fact, I don't think that they are by any means the same conditions. But I do think we're already starting to see jitters in the market because there's a huge difference in opinion now between economists on what the Fed should do. And there seems to be a big difference in opinion within the Fed itself, where a 50 basis point rate cut is going to signal to the market that the Fed is actually more spooked than it is letting on, and could be a very dangerous outcome for the markets if that is how the markets perceive a 50 basis point rate cut. So why don't we talk about rate cut expectations here for a second? For months, the rate cut expectation was that the Fed would cut by 25 basis points on September 18th. Something drastically changed recently, where now the most probable outcome, according to those who are betting using Fed funds futures, is that the Fed is going to cut 50 basis points here. This is almost a 60% chance based on the target rate probabilities according to Fed funds futures. Rarely do we see such a split, a 60-40 or 50-50 type of split this close to the FOMC meeting, which again is on September 18th. Usually there is a disparagingly higher probability that one thing will happen over the other. In this case, it's 60-40. Really, nobody knows which way the Fed is going to go. Now, why is this the case? Why did all of a sudden the chance for a 50 basis point rate cut increase to the point where now it is a 60-40 proposition? Well, it all has to do with the employment data that is coming out. So if we take a step back to last week, as of the time of this recording, you can see here that JOLTS job openings came in much lower than expected, 7.67 million jobs versus 8.09 million expected. And then if we jump to ADP non-farm employment change, we expected to add 144,000 jobs of that sort. We only added 99,000. And if you take a look at the unemployment rate, this came in as expected. However, the non-farm employment change once again came in much lower than expected, 142,000 versus 164,000 expected. And then the following week, what we saw was with unemployment claims coming in higher than expected. Now, if you couple this with what is called, we've talked about this before, but the SOM rule recession indicator, this is trying to predict a recession based on a 3-month average of unemployment. Right now, we are sitting at 0.57. Now, this might not mean a lot to you, so let's explain it just in a little bit more context. If we look at this Bloomberg article here, you could see every time the 3-month average unemployment rate has risen by more than 0.5 percentage from its low point during the prior 12 months, the ultimate result has been a much larger increase at least 1.9 percentage points and a recession. In other words, every time this has hit 0.5% from the low 12 months ago, which you could see the low 12 months ago was almost exactly 0.5% lower than where we are now, the ending result has been an increase in the unemployment rate by at least 1.9% and then a recession. So in last video, I talked about the cold water, hot water analogy, trying to explain the lagging effect of Fed policy. So, they ratchet up their interest rates, they ratchet up the Fed funds rate, and the effect that it has on the economy is lagging. But by the time they start cutting, those effects have already taken hold and will likely tend to get worse even as the Fed is cutting. So, for instance, if you jump in a cold shower, an old shower that's cold, and you turn on the hot water tap and the water doesn't become hot immediately, right? And then what ends up happening is that the water becomes too hot and then you dial it back down, but the water is still boiling. And as you're dialing it back down, the water's still extremely hot and then it goes back to extremely cold, right? So there's this sort of lagging effect that we tend to see the same thing when it comes to the Fed funds rate, especially as it relates to unemployment, where the Fed ratchets it up its Fed funds rate. It doesn't seem to have a big effect on unemployment in real time, but then over time, we start to see this wave of unemployment data come in, that even when you start lowering rates, it has already taken a hold of the unemployment or of the labor market, and really basically causes a recession. Now, another thing I want to point out is that in the United States, recessions are usually called after the fact. So even in 2007, a lot of people don't know this, but a recession was actually declared in December of 2008 for the prior year, 2007. Same thing with the 2001 recession that started officially in March. It wasn't declared until December of that year. So I expect the same thing to happen here, where we're not going to get a forewarning of a recession, but a recession will happen, and then they will tell us, hey, by the way, that time back there, that was, as a matter of fact, a recession. Also, I just want to point out that a recession doesn't mean a black swan, okay? I think there is this sort of misconception that a recession means a black swan. So when we talk about recessions, you might get comments like, hey, but this is not like 2007. We don't have a housing market crisis. Or this is not like 2001. We don't have a dot-com bubble. Yes, that's true. Also, a black swan doesn't have to happen. There have been many technical recessions that are shallow and not, to the extreme, such as 2001 or 2007, but you were still technically in a recession. So I just want to note that when we talk about a recession, we're not talking about the worst case scenario ever, similar to the Great Depression or '01 or '07. It could be just a technical recession that lasts a shallow amount of time before the economy kicks back into gear. And lastly, on this point, one could argue that the bank failures of 2023 in March, that was the actual black swan, right? But the Fed and the Treasury came in, printed more money, we backstopped it. Thankfully, we stopped a disaster, but that looked like that was going to be the black swan if the Fed and the Treasury didn't say there are no limits to what we are going to do in order to save bank deposits. In any other circumstance prior to 2008, the banks would have just failed, and the economy would have fallen into a deep recession, most likely because of so many bank failures. And then we would have to dig ourselves out of it over time. So back to what we were saying, the expectation now is that the Fed cuts by 50 basis points. And if you're asking my opinion, obviously I'm not Nostradamus, but I do have an opinion on this. So my opinion on this is that the Fed is going to cut 50 basis points. I was thinking about this, and as we are seeing this softening labor market data, I remember one thing that Jerome Powell said back in Jackson Hole. And if you guys remember, he said that a further weakening of the labor market would be unwelcome. And he said that before all of the data that I laid out to you, showing you that the labor market is getting softer or weaker, right? So I think that because of that, we are likely going to see an aggressive Jerome Powell cut by 50 basis points. Now, I don't know what's going to happen in November and December, but I think that the initial cut is going to be 50 basis points. And I think there's a big reason that the CPI number was cooked up to be 2.5%, very close to the 2% target that the Fed is actually going after. So that is my opinion. That one, I'm not as confident as I have been with previous projections of what the FOMC Fed funds rate is going to be. But that is what I'm leaning towards as of right now. Of course, I could be wrong, happy to be wrong, but that's what I think the Fed is going to do. In terms of how I think the market will interpret it, I think that initially there will be some enthusiasm. We've seen this even in dire circumstances like 2001 and 2007, where after the initial 50 basis point rate cut, the market did rally 5%. And in 2007's case, got back to all-time high before then a decline because of obviously the fact that we were in a recession. So I do believe that at least that is on the table, where we will see over the course of weeks or months a rally back possibly to all-time highs, almost certainly on the S&P 500, maybe close to all-time highs on the NASDAQ, since the NASDAQ is down a lot further. But also we have to take seasonality into account. During an election year, as I told you, August was 100% green month going back 32 years. That record has been undefeated, as August once again this year was green. However, September is 43% green and October is the worst month in an election year. So we could see some weakness leading up to the election. Then November, December are usually green months after an election, regardless of who wins. And then at that point on, it will be left up to further labor statistics to see whether the economy has weakened by a lot more or not. But I do think that we will get a recession for sure. I just don't know how deep it's going to be. In terms of actual buys in the market, what I'm looking at, what I'm looking to pick up, etc., I am still, obviously, I don't believe in being completely uninvested. And if there is a good opportunity, I will pick it up. I did pick up some Google below 150 last week, as it is suffering, in my opinion, from an overreaction of the antitrust suits. We see this time and time again with Microsoft, Apple, Amazon, etc. This is a tale as old as time as it relates to American tech companies. Our bond portfolio is absolutely skyrocketing here as TLT is well above $100 now. Looking to add to this position on pullbacks. I did buy the SPY and QQQ when we had a 10% correction very recently, as I do routinely, regardless of what the state of the market is, because you don't typically get 10% corrections on either the NASDAQ or the S&P 500. And history shows that those are the best buy points. And obviously on a day-to-day basis, we are day trading. And in that manner, I don't care whether the market goes up or down, because I will either long or short it based on where my assessment of the liquidity is. If you want to trade with me live every single day at market open, click the link in the description, sign up. I live trade with the crew every single market, every single day at market open. Anyway, traders, I will be going live for FOMC on September 18th, so make sure you check out the stream for that. I will be trading live. Also, we'll be covering what Jerome Powell is going to do. Like I said, I think that nobody's 100% certain here. 60-40 probability rate based on Fed funds futures, based on what he telegraphed at Jackson Hole and the fact that labor market data is weakening. I do think it will be 50 basis points now. Anyway, traders, let me know in the comment section what you think. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.
Also, make sure you follow me on IG if you want to track my travel stories, etc. I post way more personal stuff on there. Let me not get killed here. People are crazy. They don't even stop at the crosswalk. But yes, follow me on IG.